All right, guys, we're on section 8.2 that is discussing income tax. Certainly something that you should know about if you're going to be working and especially if you are considering filing your own taxes, which certainly saves you money, and it's just knowledge that you should know. And so it's good to file your own taxes. And so famous quote here that I'm sure everybody's heard, in this world nothing can be said to be certain except death and taxes. That's said by Benjamin Franklin. And so all of us end up paying taxes in various ways. And so our government goes through literally trillions of dollars. And a trillion is just a huge, huge number. The U.S. national debt at the end of 2004 was approximately $7.7 trillion. And that will expand to nearly $19 trillion at the end of 2015. And then what is expected to be over $20 trillion by 2017. And so our national debt just is growing way too fast. The government just spends a ton of money. And so it is all of our responsibilities as being protected by that government, having a military, having healthcare, having all those different kinds of things that come along from our federal government, national parks and services and so on. And so one of the taxes that we pay is income tax. And so we're going to talk about how that is calculated. And it is a percent of your income, but it's a little bit more complicated than that. So when talking about how to calculate your taxable income, one of the first things we need to know is what is gross income. And so gross income essentially is everything you make. Wages, tips, interest on savings accounts, dividends that you may get from stocks or other investments. Yes, you even pay taxes on your unemployment compensation, any profits from a business, of course, rental incomes if you have rental houses, winnings that you may have like from game shows or the lottery or whatever. Anything that is income to you is part of your gross income. And this is just kind of a snapshot of the Form 1040. A 1040 form, and this is the area where you calculate all of your different types of incomes to add all that up to get your gross income. So you can look through there if you want to. But then we also need to be able to calculate your adjusted gross income, or it's also referred to as your AGI. And it's calculated by taking your gross income that we just calculated and then subtracting certain amounts that are called adjustments to your income. And these things include things like paying into a retirement account or a tax-deferred savings plan. Interest paid on student loans can be an adjustment to your AGI, which may be good news for some of you. Even supplies. I know some of you are going to become teachers. Supplies that you buy for your classroom that the school doesn't reimburse you for, that can be deducted from your taxes. Alimony pay. Lots of things can be adjustments to your gross income. And so this is the section of the Form 1040 where you can add up those different adjustments to your income and then subtract those things, and that's where your adjusted gross income comes from. All right? So here's our overall formula that we used. Adjusted gross income is gross income minus any adjustments that you can make. We need to know what an exemption is. An exemption is a fixed amount for each person that the government allows you to take in a particular tax year that is subtracted from your adjusted gross income. For example, in 2014, that fixed amount was $3,950 for any person within your household that is considered a dependent of yours, including yourself. And so if it's you, and then if you're married, you would be able to take two $3,950s off of your income. If you have children or other dependents, for each one of those you can multiply $3,950 by the total number of dependents you have, and that's how much you can reduce your income by. And so this is pretty nice. It is nice that they have this and so on, and this goes up every year by a little bit. And it's essentially just kind of a thing saying from the government saying, you know, this is kind of what we expect for some of your typical expenses to be to just live, and we're not going to tax you on that amount. Not a whole lot, but it's better than nothing. Okay, and here's the line where you put it in on a Form 1040, and it says if you make over 152,000, you multiply the 3950 by how many people are in your household. If you make more than that, then there's another calculation. You have to do a different calculation. Okay, here's two terms that you need to understand the difference between. A tax credit is subtracted directly from the amount of tax owed. Tax credits are awesome. Tax credits would be things like there's a child tax credit. And so in addition to the fact that they're a dependent of yours, the child tax credit allows you, let's say once you calculate your taxes down to this point in your 1040, let's say that you owe $3,120 in taxes. Well, the tax credit is $1,000 per child. And so if you have two children, that takes $2,000 off the bottom line of your tax bill. You have to pay $2,000 less in taxes. And so a tax credit is huge. Another tax credit is like a college tuition for your children. There's a formula for it and everything. And so tax credits are awesome in comparison to a tax deduction, which all that does, it is still good, but all that does is reduce your taxable income by a certain amount. And then that percentage of tax that you owe is calculated on that amount of income. So it doesn't directly subtract it from your tax amount like a tax credit does, but it reduces your income to where then you have to pay less taxes as a percentage of that. So again, better than nothing. And the more tax deductions you can come up with, obviously, the better for you. All right, so you need to know the difference between those two. We're still determining our taxable income here. And so there's two different types of deductions that the government allows you to take. And so you can decide between the standard deduction. The standard deduction is just a lump sum that they tell you that you can take off of your taxes. All right? And so this is, again, one of those things from the government, because they try to make this as complicated as they can, that says you can deduct this amount from your income based on, again, typical living expenses, taxes you've already paid, like in sales tax and car registrations and those kinds of things. We're just going to kind of give you a minimum amount of what you can deduct based on that. So you can take that one if you want to, and some people that would be more, or you can do an itemized deduction, and this is a whole separate form when you are calculating your taxes called a Schedule A. And so this calculation is based on things that the government says that you can reduce your income by, like mortgage interest paid to a bank or a lender on a home, other taxes paid like sales tax, car registration fees, property taxes, all those different kinds of other taxes, personal property taxes, those kinds of things. Charitable contributions, and so, money that you give to your church, other charities, those kinds of things will reduce your income, and so on. There's a list on the Schedule A of things that are deductions that you can itemize. And so if those all add up to more than the standard deduction for that particular year, then it's to your advantage to use the itemized deduction. Okay? Especially if you own your own home or you're borrowing to buy your own home, especially if you give, a reasonable amount to your church and those kinds of things, then itemized is certainly the way that you want to go. So here's an example. All right? You're going to use this example to calculate taxable income. All right, so here's the problem. A single man, and that's important for our tax table, a single man earned wages of $46,500 for the year. And this sounds complicated, but we're going to break this down. He also received $1,850 in interest from a savings account that he has. He also received $15,000 in winnings on a television game show that he was on. But he also contributed $2,300 to a tax-deferred savings plan. Okay. As he calculates his taxes, he is entitled to a personal exemption of $3,800. Okay, the example I was doing was $3,950. For this particular year, it was $3,800. And a standard deduction of $5,950. So instead of itemizing, that would be the standard deduction. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes for his home and $1,855 in state taxes, state income taxes. He also contributed $3,000 to charity. So I know a lot of information there, but let's break it down step by step here. So the first question is to determine the man's gross income, just gross income. Okay, so everything that he made essentially. So his gross income is his salary, 46,500, or his wages. Okay, plus the 1850 that he received in interest from his savings account. Okay, plus the $15,000 in winnings that he had. Okay, so essentially all of the income, all the money that he received in, is his gross income. So if you add all that stuff up, it adds up to $63,350. So that's his income for the year. Question B says, determine the man's adjusted gross income. Okay, so the adjusted gross income, remember, would take that gross income, the $63,350. From there, we're going to subtract what he gave to his tax-deferred savings plan, what he put away in savings, like a Roth IRA or something like that. And that reduces his taxable income down to, or his gross income down to $61,050. That's his adjusted gross income because we subtracted the adjustments from it. All right. Now we need to calculate his taxable income. So to calculate the taxable income, we first need to determine what method of deduction is more beneficial, standard or itemized. Well, it told us in the problem that he had a standard deduction of $5,950, and we can calculate his itemized deduction based on the numbers they gave us. So he had $6,500 as a deduction, $2,100 as a deduction, $1,855 as a deduction, and the $3,000 was a charitable contribution as a deduction. So all these were deductions. One was a home mortgage, and so on. Okay, so we would add up all those deductions, and that adds up to $13,455, substantially more than the $5,950. All right, so we're going to use that. So we take his taxable income that we calculated before, $61,050, and we subtract the $3,800 that he gets to take as an exemption, and the deductions that we just calculated at $13,455. So he gets to reduce his income by the exemptions and the deductions, and that formula is up at the top of that slide right there. So if we do that calculation, it'd be $61,050 minus $17,255. That would give us a total taxable income of $43,795. So even though he made like $63,000, so let's calculate some federal income tax here. And I'm going to be honest with you, the way the book does this is a little bit, well, not a little bit, considerably more difficult than real life. But they're just doing this as a calculation type thing for you to estimate your taxes. When you actually do your taxes, there are tables inside of the tax forms that allow you to actually look up how much your taxes are. But we're going to do this calculation anyway. And it's a little bit of a complicated calculation, but we'll see that here. So here's our chart from the book. It's called Table 8.1, Marginal Tax Rate, Standard Deductions, and Exemptions. And so this is the way that we're going to look at this in order to be able to calculate our tax for the example that we just used. So we have a single man whose taxable income now that we calculated is $43,795. So the way that the tax is calculated is in the table. It says up to $8,700. And so the first $8,700 that you make under the single column, because he's single, up to the first $8,700 you make is taxed at a rate of 10%. So we're going to multiply that $8,700, the first $8,700 he made, by 10%. That's $870. So he pays $870 on the first $8,700 that he made. Then we're going to take the total amount that he made, $43,795, and subtract that first $8,700, so we get how much he made after the first $8,700. Okay, and that comes down to $35,095. So that falls within the area of the 15% tax rate, and so we will multiply that by 15. And that dollar amount comes out to $5,264.25. So that would be the tax that he would owe on the $43,000. I'm sorry, on the $35,000. The total on the $43,000 would be those two tax amounts added together. So we're going to add the 5264.25 and the 870, and that comes out to $6,134.25. That is his total income tax bill. And so you can see why you want to use those deductions and tax credits and so on to the best credit for you that you can. Okay. So there's some homework questions like this, and it will give you that table as you go do those homework questions, and they might be in different categories. All right. Let's talk about Social Security and Medicare, which is also a deduction from your paycheck, as I'm sure all of you are aware. So we are also required to pay FICA, which is an acronym for Federal Insurance Contributions Act, taxes, for Social Security and Medicare benefits. Social Security, of course, when you reach the age of 65, I believe it is, you can start collecting Social Security, and you can also have medical attention, or essentially a medical type of insurance that pays for your medical bills at that time too, called Medicare. And FICA taxes are paid on gross income from wages only. You do not get all those deductions and so on before you calculate your FICA taxes. Okay? Here's a table that allows us to see what FICA taxes are calculated at and how they're deducted from your paycheck before you even get it. Okay? And so we're going to use that table, and we're going to do a calculation as an example of your homework. So if you're not self-employed and earn $150,000, okay, what are your FICA taxes that you pay? Now, you pay some and your employer pays some, and so that's what the first two columns in the table are. The last column is if you are self-employed, you're the employer and the employee, and so you pay both of those amounts together. It's expensive as a self-employed person. But anyway, so we're making $150,000. We want to calculate FICA taxes. So on the first $110,000, we would pay 5.65%. That's what the table says. And so we would calculate that, multiply that out, and that gives us $6,215 that we would pay on the first $110,000. Then we would subtract that $110,000 from the $150,000, and we have an additional $40,000 in income, and that $40,000 is only taxed at 1.45%. And so from the table again, so we would multiply that, that's an additional $580. So altogether on our $150,000 that we earned, we would pay FICA taxes of $6,795 to contribute to Social Security and Medicare. All right, so that's a pretty straightforward calculation. Okay. All right, calculating pay, and I'm sure all of you have done something similar to this as you've gotten jobs, especially when you were younger, maybe calculating these things out. But here's our example that you will be doing for homework. You work part-time at a local grocery store. It pays $8.50 an hour, and you work 20 hours a week part-time. Right? That's what it said. Your employer withholds 10% of your gross pay for federal taxes, 5.65% for FICA taxes, and 3% for state taxes. Okay, and this is a multiple part question here. So the first part is going to ask us, what is your weekly gross pay? Well, gross pay is calculated when you work hourly like this. Your gross pay is calculated how much you make an hour times how many hours you work, right? Pretty straightforward. So in this case, we make $8.50 an hour, and we work for 20 hours a week, so that's $170 that we would make every week. So that's the gross pay every week. Second part of the question, how much is withheld per week for federal taxes? Well, the problem told us that they withhold 10%. So we take the 170 and we multiply it by 10%. $17 is held out each week to pay for federal taxes. C, how much is withheld each week for FICA taxes? Again, straightforward calculation here. We take the $170, multiply it by 5.65%, and that gives us $9.61 to go to Social Security and Medicare. Part D, how much is withheld for state taxes? Again, straightforward calculation, 170 times 3%, $5.10 goes to the state tax, for state taxes. All right? So what is your weekly net pay? Well, again, gross pay is just the total. Net pay is after you take out all those deductions, after you take out all the taxes you pay, how much money do you get left over? So we would take the original 170 and subtract each one of those deductions, 17, the 961, and the 510, and subtract all those, and we would end up with $138.29. So out of the 170 that you made, you take home $138.29. Right? Always a shock to us in our first paycheck that we ever get in our lives, right? Last question, what percentage of your gross pay is withheld in taxes? Round this to the nearest tenth. Well, there's a complicated way of figuring this out, but the easy way is just what percentage of your gross pay is withheld in taxes? Well, 10% is in federal, 5.65 is in FICA, and 3% is in state. So we just add all those up, and that's the percent of taxes withheld. So it's 18.65, but the question asked us to round it to the nearest tenth. And so rounded, it's 18.7% in total percentage of taxes that you are paying. All right? So hopefully with those examples, you are able to do the homework for Section 8.2.